This is the closing table, where we talk all things owner financing, creative deals, and how to get your transaction across the finish line. We're Team Escrow Services, and together with industry pros, we'll unpack the strategies, the challenges, and the success stories that make real estate work, even when traditional loans don't. Let's jump in.
Welcome to the very first episode of a brand new podcast that we are calling The Closing Table. I am today's host, Rachel Leday, and we are honored to have one of Team Escrow Services' very own, Jeff Miller, as our first guest on the show today. And Jeff, not only are you the business development director for Team Escrow Services, but you have 25 years of experience in the lending industry. Is that correct?
Yes, ma'am, it is.
Tell me a little bit about your background with working on the banking loan side.
Well, I spent my career doing business development, but different aspects, staying in the real estate industry in lending. So I've seen everything. So hopefully we can shed some light on this subject.
Yeah, so today we're going to talk about just kind of a broad-based understanding of owner financing and what that means for buyers and sellers, and maybe some of the challenges that come up, both on just the experience side and on the financing side that people might be faced with when they are buying or selling real estate or property. It's not something that everyone knows about. So we're going to just dive in. We have a few questions and would love to just get your candid feedback on things you've experienced, both on the lending side and the escrow side, so that people can have a better understanding about what professionals in this industry do. Okay. So the first question, we'll start with the basics. How would you explain owner financing to someone who has never heard of the term before?
Okay, so owner financing is when the owner or the seller of the property takes on the responsibilities of the mortgage lender itself, due to circumstances where the potential buyer can't go and get a normal mortgage.
So a normal mortgage would be like going to your local bank, meeting with the mortgage department, letting them run your credit, and applying for a normal house loan.
Correct.
Essentially, right? And so with owner financing, there's usually some sort of reason why someone might be facing this option. Can you maybe tell us a few examples of what might bring someone to consider, from the buyer's perspective, what owner financing would be like? What are just some real life examples that could make sense?
Well, in the buyer's perspective, it would be you don't fit into the lender's box. Your credit score, your credit history, your time in job, time in residence, sourcing of funds, meaning money for down payment has to be there for so long. There's just a number of things that could cause you not to qualify. Even though you might be qualified, you don't fit into a specific box for that particular property.
Right, that makes sense. We were talking a little earlier today about people that are self-employed, or maybe are in a service-based industry or a labor industry, or maybe their monthly income is suitable to pay for something, but they're not maybe claiming taxation the same way a traditional W-2 employee at a business might. So this hurts the box checking at the bank and could make it hard for someone who might have an income to go buy a house, but it's not necessarily in a perfect format that a banking institution is looking for. Is that correct?
Absolutely. You have people that have millions of dollars in the bank and bring in hundreds of thousands of dollars a year, and they do not fit. They can't buy a condo on the coast.
That's really wild to hear about, right? When you see that on paper, but it is true that certain banking programs have checklists essentially to get through underwriting, and if you don't meet a formula, you can't go to the next step, which just sounds kind of bizarre, but this is a reality in the lending world.
Yes, it is.
Interesting. Okay, Jeff, so I have another question for you. What are some of the common types of creative financing in the sort of lending world that might not be a standard mortgage? Give me some examples.
The main example would be owner or seller financing, which is the same. You have leasing options that some people try to get into unsuccessfully most of the time. And then you have other options like going to a private or hard money lender in extreme circumstances. Those are more for, flip properties. If you've got the money to pay a higher interest rate, it's a quickie where you can get in there, do your thing, and then get out.
So that really wouldn't be a suitable option
Not
for a
for
home buyer
this,
'cause
not
it's too
for,
short
yeah,
term.
it's not the standard for a normal home buyer.
So one of the key topics we're going to introduce is this bond for deed idea, which is a category in creative financing and something that we think is a lot more protective for the buyer and the seller because of the sort of legal and financial processes that go on. So can you explain in your own words and kind of in layman's terms what is a bond for deed and what are the benefits on both sides that someone might experience if they decide to go the bond for deed route?
Well, a bond for deed is basically the owner or the seller of the property. They're taking on all the obligations of a normal lender or mortgage company. So what they're doing is they're saying, okay, I want you to buy my house. You can make the payments directly to me. I'm going to be responsible for making the payments, paying the taxes. I'm going to keep the title in my name most of the time until you get to a certain point. It's pretty self-directed, so the terms can be any one of 1,000 different directions. So it just depending on what the two parties agree on, but to get them into the house.
Okay, Jeff, so we're talking about how the contract can be written in a flexible sense with a myriad of options for the buyer and seller that makes sense for them. One of those things is the interest rate. So if you're selling something to me, we would agree on an interest rate for our loan payment, and you would basically act as the bank for me while I'm paying you
Right.
for the loan. And then there's usually some type of down payment that is part of that agreement, as well as a term. I've seen it anywhere from 1 year to 3 or 5 years, where the buyer has time essentially to gain equity and maybe clean up their credit or adjust things so that they are able to finance out in a traditional sense at some point. Is that accurate?
Absolutely accurate. So you can use it. It's between the two parties. You can agree to anything. Anything is on the table until they agree upon it. You could use it, for example, if I'm looking to, if my primary objective is to possibly flip the house, we can agree to shorter terms. If I know I have those options down the road, all the way to I can't get a loan today, I can't get a loan tomorrow, no matter what the rates do, and they're talking about the rates dropping, of course. That still may not be an option. It may be, depending on what the buyer is looking for at that time, or what their certain situation versus what the seller is willing to put down into the contract.
So let's talk a little bit about the presumption that the rates could change, which would be great for everyone if the rates did drop. That's a whole other podcast. But if someone was in a situation where maybe they were close and they were able to do an owner finance situation for maybe a year, waiting to see if the rates would change and maybe that would help them to get a traditional loan, could they use a bond for deed scenario to gain equity in the property and also buy them some time so that they could lock in that property? Like if they love a house in a certain neighborhood and the seller is in agreement to it, it could almost act as a buffer until things did change or maybe their situation changed.
Oh, yes. And I've seen lots of examples for that. So as I said before, you have certain criteria in the bank box or the lender's box. So you might have a situation where The only reason that the buyer is not qualified is time in job. Well, it's a year, we need 2 years. So let's do a year contract, and then the lender or the buyer is going to qualify for that loan. So then they can switch to a conventional. So if that's agreed upon, absolutely. It can be used for anything. Absolutely anything.
That's the great thing about it, right? It's very flexible.
Absolutely.
We know that there are some risks with a transaction like this. Can you explain to our audience how using the correct escrow servicing company like Team Escrow Services helps to kind of show up and iron out the details for both sides, but also protect both parties for the duration of a owner financing term like a bond for deed?
Right. Well, the escrow services is going to take the liability off of the seller. They're going to be responsible for filings. They're going to be responsible for the proper documentation, collecting the payments, distributing the payments to the current owner, everything involved that takes all of that stress and liability off the shoulders of the seller.
So anything with taxes, anything with collecting payments, you're not knocking on doors asking for a check. It really kind of adds professionalism to the whole scenario.
Because when a bond for deed, I mean, this is not a new concept, but when bond for deeds are used unofficially, not through a escrow services, a licensed escrow services, because there's a lot out there too. Yes, there's a lot out there that claim, but they're not. When they go through that, the contract's written, and then once again, the seller is burdened with these things. They have to collect the payments. They have to, let's say, hopefully not, but it gets to a time where the people aren't making the payments. Guess who's knocking on the door? And then they've got to go through all that legal process to get rid of the person that's supposed to be buying their house.
And the escrow servicing company can step in and provide all the documentation.
They take care of all of that.
And
it's just, you've got,
it's a peace of mind offering.
Absolutely.
Really. The other thing I think is really great is that if someone is enhancing their credit, or they're trying to prove that they've done really well and earned equity over time, they get all the paperwork every month also, so that when they go apply for whatever they're trying to apply for, even if it's a next loan or something else, they have a third party that's documented it all. So that it's not just their word against some landlord, but they really have stake in the game and can show that they have been there and paid. And maybe it's that year situation where they're trying to gain employeeship in a business setting. And so it just kind of helps everyone to present factual information by a licensed escrow service.
Yes, it keeps everybody honest, both sides, because things happen. People aren't always willing they see a shortcut on both sides. And this keeps everybody honest.
Our last question today, Jeff, is if you had to give one piece of advice to someone considering owner financing for the very first time, whether it's a buyer or a seller, what would that piece of advice be?
Absolutely, to utilize a licensed escrow services company. Peace of mind, like you said.
And Team Escrow Services is located where, and how can people get in touch?
You can go to teamescrowservices.com, and we also have, you can get in touch with me directly or any of our people, several offices in Louisiana, and we're looking forward to working with you.
Also, one last note, with today's environment with hackers and impersonators, we want to make sure that our viewers know to be sure to check for official Louisiana state licensing, because that makes a really big difference in protecting you as a buyer or seller if you're going to do this creative financing method. So please be sure to check that out before hiring an escrow services company. This has been a great conversation today, Jeff. I hope this helps people who are considering creative owner financing, and we'll look forward to talking with you next time.
Thank you.
Thank you for joining us on The Closing Table, where we make real estate work. Stay tuned for future podcasts where we discuss real challenges and solutions across the industry.